Today in this video, I am going to explain you one of the theories of the capital structure, that is the net operating income approach. Net operating income approach is one of the theories of the capital structure. When we talk about the term capital structure, which is a part of business finance or financial management, then the whole chapter of capital structure revolves around few things, that is cost of capital, debt and equity, value of firm, and capital structure decision. I repeat these words. Cost of capital. Cost of capital is an expense which is borne by the capital. Then if we talk about the capital, then debt and equity forms the part of the capital, like debentures, loan from financial institution, anything which comes under the borrowed fund becomes the part of the debt. And under equity, over here I am just writing equity because when we are talking about the theories of the capital structure, then we are specifically talking about the equity shareholders. Rather, you can say that capital structure is a mix of borrowed funds and the proprietors fund. Under proprietors fund, we even take equity shareholders plus preference shareholders. So it is a mix of debt and equity. Now, capital structure has an effect on the value of firm. The reason behind, there are over here there are some theories which says that capital structure is relevant for the value of the firm, and there are some theories which says that capital structure is not relevant for the value of the firm. I think before you watch this video, firstly you watch my first and second video, and then comes to the third video, which is net operating income approach. Because to understand this theory, firstly you need to understand the basic concept of the cost capital structure and net income approach. Then only you will understand net operating income approach. In this capital structure decision, there are few theories which says that capital structure decision is relevant. When we use the term that capital structure decision is relevant, it means that capital structure affects the value of firm. Basically, when we say capital structure affects the value of firm, it means that the mix of debt and equity, increases the share prices. The mix of debt and equity increases the share prices. Let's understand the theory of the capital structure. In this diagram, you can see that on y-axis I have plotted cost of capital, and on the x-axis I have plotted degree of leverage. Degree of leverage again means that how much debt and equity we are going to use, and cost of capital is the cost which is borne by the firm when they are issuing the different sources of fund. For example, like if they are issuing debt, then they are paying interest. If they are if they are issuing equity, then they are paying dividend. In this, there are these lines KD, KO and KE. KD is parallel to x-axis, KO is also parallel to x-axis, and KE is diagonal to x-axis. KD represents cost of debt, KO represents overall cost of capital, and KE represents cost of equity. Cost of equity is dividend, cost of capital you all know, and cost of debt is interest on debt which is being paid. In this diagram, it is being represented that KD is a straight line, KO is also a straight line, and KE is a diagonal line, which shows that it keeps on increasing. Before understanding this diagram, firstly you need to understand the assumptions of the theory. The assumptions of the theory are cost of debt is lower than the cost of equity. Over here I am saying that cost of debt is lower than the cost of equity. The basic reason behind this is that it may be that today your income is 1 lakh and you have to pay interest rupees 2 lakh. Then only interest remains 2 lakh. If your income is 10 lakh, then also you are paying to the debentures holders only rupees 2 lakh. If your income is 100 crore, then also you are paying only rupees 2 lakh. But if we take the example of cost of equity, then it may be that your income is 1 lakh and you are not paying anything to your equity shareholders. But with the passage of time, when your income increases to rupees 10 lakh, then you have to pay more interest to the equity shareholders. And if your income increases to rupees 10 crore, then you have to pay more to your equity shareholder. It means that equity shareholders are the owners of the profit, they are the partners of the profit. So if you are gaining more and more, then you have to pay to your equity shareholders. You can't escape the situation that you don't pay to your equity shareholders. But in the case of debt, the interest on debt remains fixed. That's why you say that cost of debt is lower than cost of equity. I think you must have understood this point. Now we come to the second point, that is risk for debtors does not change. Please note that I am not saying that risk for equity shareholders is also not changing, but rather over here I am just saying that risk for debtors does not change. It means that if you are issuing more and more debt, then your debenture holders does not demand you more dividend. They remain constant. They does not bother whether debt is being issued more and more. But in this, I am not taking the assumption that for equity shareholders, risk is constant. Risk is not constant for the equity shareholders. Well, this is not prescribed in the presumption, but when you are studying this theory, this will come that for debtors risk is constant and for equity shareholders risk is not constant. And now market capitalizes the whole value. With this we mean that market capitalizes the whole value. It means that for the investor, they are not bothered how much debt and equity they are using. They are in totality taking into concern that the capital mixes of debt and equity. So market or investors are concerned about the total capital of the company. There is one more assumption, no corporate or personal income tax. Regarding these assumptions, I will say that right now you shouldn't bother with this assumption. Firstly, you should understand the theory, and then only later on you will understand these assumptions. Okay, now come back to the theory, that this is the theory and this is the diagram. Now when you will see this diagram, then in this what is happening, that this theory is saying that capital structure decision is irrelevant. The basic reason behind saying that capital structure decision is irrelevant is that if we are increasing more and more debt, then the cost of equity is increasing with the use of more and more debt. Again, I repeat that capital structure decision is irrelevant, and with the use of more and more debt, the cost of equity starts rising. You may ask me that why the cost of equity is rising. The reason behind the increasing cost of equity is that the risk perception of the equity shareholders keeps on changing. For example, if I say you that in your business you have more debt, you are taking more loans and loans, so what happens to you? You feel that the risk is increasing. So in the business also, if you are taking more and more if you are using more and more usage of debt in the capital, then equity shareholders may feel that this is not safe for them, because the business is relying more on debt and not on equity. Because the basic reason for business using the debt and equity is that debt is a cheaper source of finance. So they feel that if they are going to use the debt in their capital, then they are more towards the cheaper source of finance and less towards the expensive source of finance. So there is